Imagine the stock market as a vast, bustling marketplace that never truly sleeps. But instead of fruits or electronics, what's being traded here are tiny pieces of ownership in companies. These are called stocks. Every day, millions of people from all over the world log in, call in, or even shout across trading floors, all hoping to buy or sell these shares at just the right moment. This global marketplace connects investors, companies, and even entire countries, making it one of the most dynamic systems on the planet. When you buy a stock, you're not just making a simple purchase, you're placing a bet on the future of that company. You're saying, I believe this business will grow, innovate, and succeed. If you're right, the value of your stock can rise, and you might make a profit. But if things go wrong, you could lose money too. That's the risk and the thrill of investing. Stock prices are in constant motion, changing every second as new information pours in. News stories, rumors, and even tweets can send prices soaring or tumbling. It's a real-time reflection of what people think will happen next. Sometimes logical, sometimes emotional, but always fascinating. For example, when a company announces a breakthrough product or reports higher than expected profits, investors get excited and the stock price can jump. On the other hand, if there's a scandal or disappointing results, prices can fall just as quickly. The market reacts instantly, rewarding optimism and punishing fear. But the market isn't just about individual companies. Sometimes, huge events, like elections, wars, or decisions by central banks, can move entire markets at once. These big shifts can affect millions of investors and even change the course of economies. The world's markets are deeply interconnected, so what happens in one country can ripple across the globe in seconds. Investors, analysts, and experts are always on the lookout, trying to predict how these events will shape the future. They study trends, analyze data, and debate what might come next. It's a constant game of strategy, intuition, and sometimes luck. Today, September 9th, 2025, Asia's markets are each telling their own unique stories. From Tokyo to Shanghai to Hong Kong, every exchange is reacting to a different mix of local news, global trends, and investor sentiment. In Japan, for instance, the stock market just hit a record high. But it wasn't a new invention or a blockbuster earnings report that caused the surge. Instead, it was the sudden resignation of the Prime Minister, a political event that sent shockwaves through the financial world and changed investors' expectations overnight. This dramatic move shows just how closely politics and economics are intertwined. Decisions made in government offices can have immediate and powerful effects on the financial markets, influencing everything from stock prices to global trade. A single headline, a policy change, or even a rumor can send powerful signals to investors everywhere, triggering waves of buying or selling that echo around the world. In the end, the market is more than just numbers on a screen. It's a living, breathing reflection of how people feel about the future, shaped by hope, fear, and everything in between. Japan's Nikkei stock market just reached an all-time high. The trigger? The sudden resignation of the Prime Minister. Normally, political uncertainty makes investors nervous, but this time, it sparked a buying frenzy. Investors saw the leader's departure as a chance for positive change. It suggests they weren't happy with the old economic policies and are hopeful for new, business-friendly ideas. The market's surge isn't about the drama, it's about the potential for growth. Investors are betting the next leader will boost the economy. The record high is a vote of confidence in a more prosperous future for Japan. Sometimes, change itself is the biggest opportunity. It might seem odd that a leader stepping down excites investors. Usually, markets crave stability, but they're always looking ahead. The resignation signals a fresh start and the hope for better policies. Investors may have felt the old government was holding back growth. Now they're betting on change, even before a new leader is chosen. It's like a sports team swapping out a coach. Fans get excited for new strategies. The market isn't reacting to what's happened, but to what could happen next. Investors are energized by the potential for pro-business reforms. The Prime Minister's resignation is a reset button for Japan's economy. The market's rally is the crowd cheering for a brighter future. The stock market runs on confidence, on how people feel about the future. When investors are optimistic, they buy stocks, pushing prices up. The Prime Minister's resignation wiped the slate clean, replacing worry with hope. A new leader means new possibilities and a new story for the economy. Markets often move on expectations, not just current facts. The value of a stock reflects what people believe about its future. In Japan, hopes for business-friendly policies have boosted those expectations. It's like hearing a new highway will be built near your home. Values rise on anticipation alone. The market is pricing in a better future before it even arrives. Confidence is the fuel that drives markets higher. While Japan celebrates, investors worldwide are watching the U.S. Federal Reserve, the central bank that sets interest rates. The Fed's decisions ripple across the globe, affecting everyone. Lower interest rates make borrowing cheaper, boosting spending and growth. Higher rates slow things down to control inflation. Investors constantly guess what the Fed will do next, searching for clues in every speech and report. Lower rates are good for stocks. Higher rates can pull money out of the market. When safe investments pay little, people turn to stocks for better returns. The Fed's next move could shift billions of dollars worldwide. This global guessing game adds another layer to market movements. What happens in Washington can lift or lower markets everywhere. The U.S. Federal Reserve's decisions don't just affect America, they send ripples worldwide. Every time the Fed meets to set interest rates, investors, governments, and businesses across the globe pay close attention. The choices made in Washington, D.C. can shift the direction of global money flows in an instant, impacting economies far beyond U.S. borders. The U.S. dollar is the world's main currency, and its economy is the largest. Most international trade, from oil to electronics, is priced in dollars. This means that when the U.S. changes its interest rates, it doesn't just affect American borrowers and savers. It influences the cost of money everywhere. Central banks, multinational corporations, and even small businesses in distant countries feel the impact. When the Fed lowers rates, investors earn less from safe U.S. bonds and look abroad for better returns. Lower yields in the U.S. make emerging markets and riskier assets more attractive. Investors start searching for higher profits in places like Southeast Asia, Latin America, or Africa, where growth can be faster and returns potentially higher. This sends waves of money into faster-growing markets, like those in Asia, driving up their stock prices. As foreign capital pours in, local currencies can strengthen, and companies find it easier to raise money. Booming stock markets can fuel optimism and growth, but they can also create bubbles if too much money chases too few opportunities. If the Fed raises rates, money flows back to the U.S., pulling down markets elsewhere. Higher U.S. rates make American assets more attractive again, so investors quickly move their money out of riskier markets and back into the safety of the dollar. This can cause sharp drops in stock prices and currency values in other countries, sometimes triggering financial crises. A single decision in Washington can spark rallies or downturns in Tokyo or Seoul. The effects can be immediate, with markets reacting within minutes to Fed announcements. Even rumors or hints about future U.S. policy can set off waves of buying or selling across continents. Japan's market is surging now, but its future depends on both local politics and U.S. policy. Japanese companies and investors must constantly weigh domestic factors, like government reforms or Bank of Japan decisions, against the powerful influence of the U.S. Federal Reserve. Investors in Japan are celebrating, but they're also watching the Fed closely. Every speech, press release, or economic report from the U.S. is analyzed for clues about what might happen next. The mood in Tokyo can shift overnight based on news from across the Pacific. The next big move in Japan's market could be triggered from thousands of miles away. In today's interconnected world, a policy change in the U.S. can set off a chain reaction, influencing decisions and fortunes in places as far away as Tokyo, Mumbai, or Sao Paulo. Global finance is a delicate balancing act. Investors, governments, and central banks must constantly adjust to shifting conditions, trying to stay ahead of sudden changes in capital flows and market sentiment. Every market is connected in this worldwide web. In the end, a single decision in one country can echo across the globe, shaping the fortunes of millions and reminding us just how tightly our financial destinies are linked. Stock prices move up and down because of a simple but powerful force: supply and demand. Every day, millions of investors around the world are buying and selling shares, each with their own reasons and expectations. The price of a stock is determined by how many people want to buy it compared to how many want to sell it at any given moment. If more people want to buy a stock than sell it, the price goes up because buyers are willing to pay more to get their hands on those limited shares. On the other hand, if more people want to sell than buy, the price drops as sellers compete to attract buyers. What makes people suddenly want to buy or sell? Often it's the news. News about a company, the economy, or even world events can quickly change how investors feel. Good news, like strong earnings or a new product, can spark a buying frenzy, while bad news, like scandals or economic troubles, can trigger a wave of selling. Imagine an electric car company announces a major technological breakthrough. Investors get excited, believing the company will make more money in the future. Suddenly, everyone wants to buy its stock, pushing the price higher as demand surges. But if that same company faces a massive recall or a damaging report, confidence can evaporate in an instant. Investors rush to sell before the price falls further, and the stock can drop sharply as a result. This basic logic doesn't just apply to individual companies. It affects entire markets, sectors, and even global exchanges. When big news breaks, it can send ripples, or even waves, through financial markets everywhere. For example, when the Prime Minister of Japan resigned, many investors saw it as a positive sign for the country's economy. They expected new leadership to bring fresh policies and reforms. As a result, investors started buying stocks across many industries, not just in one company. This broad optimism can lift the entire market, as people anticipate better times ahead. That's why the Nikkei, Japan's main stock index, soared to a record high. It was a collective vote of confidence from investors, all reacting to the same big story. In the end, markets are always in motion, constantly reacting to the latest headlines, rumors, and expectations. That's what makes prices go up and down every single day. Understanding markets is like solving a giant puzzle. Every piece, political events, interest rate changes, company news, fits together to create the big picture. Japan's market surge is a local story, but it's happening in a global context. Internal optimism meets external forces like the U.S. Federal Reserve's decisions. If investors expect U.S. rates to fall, they look for better returns abroad, like in Japan. Local hope and global money combine for a powerful effect. News from one country can ripple across the world. Japan's market is up because of political change and global investor interest. Every element influences the others. A change in one place creates opportunities or risks elsewhere. Seeing these connections helps you understand why markets move. Finance can seem intimidating, but at its core, it's about people, hope, and simple rules. Today's events in Japan show how political change can spark market optimism. The market always looks forward, valuing potential over the present. Events in one country are deeply connected to others, like the U.S. Federal Reserve's decisions. Understanding these links is key to making sense of the global economy. You don't need to be an expert to follow the story. By paying attention and asking questions, you can connect the dots. The stock market reflects our collective hopes and fears. It's a story you can learn to read, one headline at a time.